Garry Barnes. Welcome to Stringham Real Estate Edge. Today's guest is Dan Densley, Senior Advisor at Axia Home Loans. Dan, thank you for being with us.
Good morning.
How long have you been in the mortgage business, Dan?
In the mortgage business, about 38 years.
So you're just kind of getting started.
I'm learning how the process works. I started out in being a realtor for a lot of years, and then went into the title industry and tried that for a little bit, and finally found a home in the mortgage industry.
What attracts you to the mortgage business?
Most of the time, it's really just the idea of learning what people need and seeing the differences between people's needs and wants and what they're trying to do, and trying to help them, whether it's a $100,000 purchase or a $5 million purchase.
What are the barriers to entry, if you will, or what are the licensing requirements for a mortgage?
If you're going through the first time, you need to take 20 hours of total study time, and that's going to be split between state knowledge and federal knowledge, and you get to do that every year.
I see.
If you're relicensing, it's not 20 hours, it's 12 hours. But every year you relicense to be able to stay licensed and be able to do the business.
And originally, then, is there an examination of some type?
Oh yes, yeah. All of the licensing time that you spend, there's testing afterwards.
I see. Is Axia a local company?
Axia, it's a branch of a company in the Western United States.
I see. How big are they?
We're in all the Western states in the United States. We're in Minnesota, Texas, and I think that's they're working on a couple of others, but mostly just the Western United States.
Where are they headquartered?
Out of Bellevue, Washington.
I see. And can you give us an idea, just roughly, how many either dollars or number of transactions they would do a year?
Well, right now, year to date for 2020, we're at just under $3 billion in total volume closed. Have another 4 or 5 billion left to close before the end of the year. About 7,500 loans.
That's a lot of transactions.
A lot of transactions.
A lot of zeros. Dan, do you have an area of specialization? What type of loans do you specifically work on?
Mostly just your residential.
Okay.
Single family to 4 unit multifamily homes, and I've done business from Ogden down to St. George.
So can you practice in any state?
No.
Or you said that's an individual state licensing requirement?
Right. Every state has their own specific licensing requirements. Once you do the federal licensing, then you have to be involved with getting approved by each particular state that you want to do business in.
For the new borrower that is either preparing to buy a home or that has already found a home to buy, what's the process? What should they do to sort of prepare for this journey?
My experience over the years has been that, number one, they don't really know what to do.
That's true.
Will go online and think they want to go buy a house, and then they'll call a realtor friend or a family member that's in the real estate industry, want to go look at the house, and then they finally get to the point of going, hopefully the real estate agent will suggest to them that they should be talking with a particular lender before they even go out and look. In today's world, all the real estate agents will want to know something from a lender that says that they've had that borrower's information looked at and reviewed, and they can meet general qualification guidelines.
So at what point in the process should that borrower contact you?
Almost before they even talk to a real estate agent.
Okay.
Most of the time, they don't know who to talk to. So they'll talk to their real estate agent, and if the real estate agent is doing what we in our industry believe they should be doing, they should be telling those clients, I won't take you out and show you a house until you talk with a mortgage lender.
What's your biggest source of new business, referral source, that is?
Mostly real estate agents. I've been doing it long enough that I get a lot of business from past clientele, and they'll spread the word about how great of a job that we did in the past,
Sure.
and you should try and talk to Dan and all those kinds of
Indeed.
things like that.
Can you tell us specifically, typically, how does the application process itself start? Let's assume that they're just new in the process. They haven't found a home yet. They come to you and say, Dan, I want a loan. What will you tell them to start doing?
Initially, I'll have a conversation on the phone, and that conversation could last anywhere from 15 minutes to an hour. Trying to, for me, for what I've learned over the years, to find out what it is they're looking for. They don't know what to ask, and so
I'm sure
they'll talk to a brother, a friend, or something, and those people will suggest to those people, make sure you find out what the rate is, or what is the closing cost, or whatever. And I try to find out. I go a different route with that. And I think it's very important to find out exactly what those clients are trying to do with their financial situation and their future and
Sure.
things like that.
Well, that's probably their first question, isn't it?
Yeah, completely.
What's the interest rate?
Yeah, and again, my experience over the years has been that they don't know what else to ask. So when they ask me what the rate is, I will give them rates right now today are so tied into many different things than they were in the past. And until I know someone's credit and how much money they want to borrow, how much down payment they're going to have, what kind of a property are they going to buy, and what area are they looking in, and a few of those things. All of those factors go into to determining what kind of a rate. I could say today the rate is 3.
Sure.
As you go through the process and you find out that their credit wasn't as good, or it was better than what they initially thought, or they have more money down than they initially told you, or they're looking at a primary residence rather than a second home, or a second home rather than a primary residence or investment property, then we start narrowing down where we can go with interest rates.
What type of documentation do you require for that home buyer, either the first time home buyer or someone that's even been through the process before and are upgrading? Is that documentation the same?
Documentation's the same. From my perspective, we have just 2 or 3 things that we get to make sure for every client that's looking to buy a home. What's your income? Is it salaried? Is it hourly? Is it overtime? Is it bonus? Is it commission? And the documentation requirements for each of those are completely different. How much money do you have? Where is it? Where are you getting it if you don't have it? You don't have any money. How's your credit? What do you think your credit looks like? I've had circumstances where a client says, oh, I've got great credit. And then you look at a credit report and they just paid off a bankruptcy and figure they don't have any debt.
Sure.
So their credit's really good.
Is there an application itself that must be filled out?
Yes.
Is that kind of the start, the beginning of the process?
Once I have basic information, and I suggest that we move forward after we've had a discussion about what they want to do and how they're going to attack this whole issue. We have at Axia, we have an application that we can either email to them that they can do online, or it's a phone app and they can do it on their phone. As we get into, let's say, the millennial group, most of them are way more tech savvy than I ever thought of being. So I can send them the application on their phone, and they fill it out, and when at the end of the application they click send, then it comes right directly to me, and then I look at the information, start deciphering what it is that I think they can do based on the information I have, knowing that I get to document and verify and validate everything that is they
Sure.
put on that application.
What do you require in the way of financial information?
Mostly, again, just depending on what their pay structure looks like. I need like W-2s, pay stubs. Sometimes, depending again on the type of income they receive, we might need tax returns, federal tax returns. I don't care about the state, just the federal tax returns. We'll need bank statements to see what money they have or don't have or whatever.
Is it just 1 year tax return if you require it?
A lot of that will depend, recently depends on how good their credit is, how much money are they putting down. We have a system, it's an automated underwriting system that Fannie Mae and Freddie Mac put out that will say, okay, just get me the last year's tax return. Guideline in all the underwriting manuals says we need 2 years worth of tax returns, 2 years of history if it's any kind of variable income. If it's a salaried job or an hourly job and a pay stub shows they make $20 an hour for 40 hours a week and that's what the pay stub shows, I might not need tax returns.
So do you validate all this information that's given to you in some form?
What I get to do is I get to look at it, and based on my experience, I will look at it and say, based on what I see, yeah, you meet it, this is information we can use to get you approved. I don't give them the final approval.
Okay.
I still have to have the loan underwritten by our corporate underwriters.
And so the processors or underwriters, they may come back and say, we need to validate this. We may need tax statements or additional tax returns. How do you confirm that the tax return is correct?
Because they give us that tax return.
So
and
based on that,
trust them.
You have to assume that it is accurate. Okay.
Yeah, we will also reach out. There's a system that we have access to that most lenders will have access to that we can validate a tax return by sending in information, and then we get the information sent back to us.
You mentioned automation a moment ago. How has technology changed the industry over the years?
Well, when we have the information that we need and we send it into this automated underwriting system, the terminology that we use is AUS. When we send it to that, it has a pro forma information in the system that says, okay, I need, based on what you've put in the application, I'm going to need 30 days worth of pay stubs, or I'm going to need 2 years W-2s, or I'm going to need 2 years tax returns, or whatever all that is. And so it makes it a little bit simpler, and hopefully by the time myself and my loan processor as a team send it off to the underwriter, we've got the information in there that was asked for by Fannie Mae or Freddie Mac.
Sure. Can an automated process make a better decision than a human being when it comes to evaluating and saying yes or no?
Interesting question. I don't know that it's a better decision, but underwriters are paid to know the guidelines.
Sure.
And if I put information into the system for the automated system, and something an underwriter sees doesn't validate that information, the underwriter can come back to me, even though the automated system says it's approved. The underwriter may come back and say, I need another pay stub,
sure,
or I need you to clarify what this means or what that means. And
so in most cases, it may be decisioned by the computer, but it will also receive a set of human eyes that will evaluate and confirm that the automated decision is realistic and within guidelines.
Yeah.
So we're not to the point where computers have sort of taken over the decision-making process yet.
What we're seeing more recently, based on how values have trended, and I don't know if it's specifically in Salt Lake, but nationwide, when we put information into the automated system, we're seeing a lot of decisions come back where we may not need to have an appraisal done. We put a value in for that home, and somewhere, somehow, Fannie and Freddie have decided that value's a good value for that particular property in that particular area, and they'll give us what we call a PAW, Property Inspection Waiver.
Is there a minimum amount or a maximum amount that an appraisal is required?
The appraisal, when you borrow money specifically, and you say I will pay X amount of dollars for a particular property, we base our loan amount, our loan to value, how much of the total value you're going to borrow, we base it on the lesser of the appraised value or the agreed to value.
Okay.
So if you have for simplistic numbers, if I have $100,000 purchase price that all parties have agreed to, and the home appraises for 150, my loan to value is going to be based off of the 100,000.
Sure.
If it comes in at 90, then my loan to value is based off of the 90.
But do you have to have an appraisal to confirm the value?
Yes.
Regardless of the dollar amount?
Yes.
Okay.
And that's why I say with the automated system, if we put information in and it comes back and says you don't need an appraisal, then you've put a value in, because inevitably we will talk to you as a client and go, what do you think your house is worth?
Sure.
I think it's worth 400. That's what I put in the application. That's the numbers we base everything off of. If I get a purchase contract from a real estate agent, then they agree to that $400,000 purchase price. That's the number I put into the system.
Is it best for the potential borrower to find a house or a potential home before they come to you? Or is it just the reverse? Should they come to you first?
I believe they should inevitably come to us first.
Okay.
As the real estate agent makes an offer on a property, inevitably in today's market, the agent wants a letter from a lender saying that we've looked at all their information and they can qualify for purchasing that particular home.
So that's in effect a pre-approval letter?
Right.
Is that subject to what?
Differences are there's a pre-qualification and a pre-approval. So
what are the difference?
Well, what we want to do is we want to get them pre-approved.
Okay.
To be pre-qualified, that means that an underwriter has gone through and looked at all of their income information, has verified their credit, looked at their cash available, and if they buy at a certain price point, then we can approve the loan. The pre-approval is just, I've looked at it, says I've looked at it, I've verified the information, but the loan still has to be underwritten by an underwriter.
Okay. How do you decide which loan program best fits the borrower? Whether, and by that I mean, is it a conventional conforming loan? Is it an FHA loan? Is it a VA loan? How do you coordinate or identify which box they fit in?
Most of the time, to do a VA loan, you have to be a veteran and have 180 days worth of service, active service. So that will limit who can look at a VA type of loan.
Okay.
FHA, generally speaking, not always, is for first-time home buyers because they have a lot more flexibility in their guidelines and how they look at a particular loan or how they look at the qualifications of the particular borrower. And the down payment can come from different sources that are not as strict as what it might be for a conventional loan. FHA, you need 3.5% down. And that can come from a gift. It can come from a bond loan, which is what the state government offers to borrowers in Utah. Other states have them as well. Conventional loans need 3% down minimum, but that has to come from very specific sources. So when we look at their circumstances, if they have $100,000 down, they're not going to look at an FHA loan for a variety of reasons.
So FHA is not only for first-time home buyers, but also those that may be upgrading or moving or changing.
Generally speaking, with FHA, it's cash availability.
I see.
They have limited resources. They may have had another aspect would be their credit. They may have a couple of dings on their credit that if I'm looking at a conventional loan with 3% down, which is less than what FHA requirements are, you better have very, very stellarly good credit. FHA, you don't need to have that great a credit.
Can you use FHA to buy a second home?
No. FHA is owner occupied, that's it.
Okay. Is that 1 to 4 properties?
Yes. Yeah, residential lending is single family up to a fourplex.
Okay.
But if you're going to buy the fourplex or the duplex, which you can do with FHA, you have to be an owner occupant. They don't do investment properties.
Given the current interest rate levels at the 3.5% range, how can a lender make a 30-year fixed rate loan for that period of time without regard to what's going to happen to interest rates in the future? 30 years, we may go through 2 or 3 business cycles. How can they do that?
Trusting what they've done. I mean, they've looked at markets and they know where what they can do with the cost of funds that they have to deal with. I mean, most investors, Fannie Mae, Freddie Mac, with bond markets and mortgage-backed securities, they can get a lot less. The cost of their funds is a lot less than what we're offering to a potential borrower.
I see.
So if I'm a client and I have to pay a 3% rate, there's probably built in there someplace where Fannie Mae is going to get a 0.5 point and the bondholder is going to get a 0.5 point, and then there's the cost of funds beyond that. So it could be a full point below what the borrower is going to pay.
Sure. So real estate interest rates are based off a different set of criteria. What I've read is that based off the 10-year bond, 10-year treasury. So I guess that would assume that the average life of a deed of trust or a mortgage is not 30 years.
Right.
It's substantially less.
Is there in the world right now? It's probably 7 years.
Oh, it is.
Yeah.
It turns over that fast.
Most
so
people.
In reality, lenders aren't making a 30-year loan.
No.
They're although it's priced at 30, and the anticipation it may run 30, but the average may be 7-8 years.
Yeah.
Interesting.
Yeah.
So I guess that answers the question. It's
for sure.
Not really.
Yeah, it's most people will, their family sizes increase, their family sizes decrease. They come into a pile of money, and then they pay cash for a house where they don't have to worry about financing. There's a lot of factors that go into where we think in our industry, where we think things are generally. And people get relocated with their jobs, and it happens much sooner than 7 years.
Indeed,
normally.
It does. Sure. Well, you mentioned FHA down payment at 3.5%. What are the down payment requirements for, say, one of the loans we're talking about, a conventional 30-year fixed rate?
You can get
mortgage
as little as 3%.
Oh, really?
You can
also on the conventional?
Yeah, you can get FHA is going to be 3.5 regardless. I mean, if you buy or want to do a conventional loan, I've had clients in the past that just refuse to pay mortgage insurance, and we can talk about that.
How does that kick in?
With conventional financing, you have to put at least 20% down, and then you eliminate private mortgage insurance, which is, for all intent and purposes, default insurance.
Okay.
If you default on the loan, then that mortgage insurance kicks in and protects the lender from massive losses on that default.
So if you only have 15 to 18% down payment, then mortgage insurance in most cases would be required.
Yes, yeah, and with conventional financing, it's based on 0 to 10% down. So 80 or a 90% loan, 85% loan to value, 97% loan to value. The factor is different on conventional financing. With FHA financing, you can put 50% down, and no one better tell you to do an FHA loan if you have 50% down.
Sure, indeed.
But the mortgage insurance factor with FHA is it's dramatically higher.
Are most mortgages sold, or are they retained as portfolio loans?
For the most part, maybe some of your larger banks may hang on to them for a while, but inevitably there are ratios that the government sets that says you have to have a certain amount of cash in the bank. You can have this much lent out and be receiving servicing on
I
this
see.
much. And when that balance becomes out of whack, then you'll find all kinds of lenders, banks, whomever is servicing that loan generally will bundle a bunch of them together and sell $100 million.
Who to? Who do they sell them to?
Somebody that needs the
Just
servicing that's
other
got
investors.
too much cash.
And that's known as a secondary market.
Secondary market for sure.
Are there who represents the biggest share of the secondary market? Is there any one
No, it's
federal agency or organization that
no.
would capture the majority of that?
Fannie Mae and Freddie Mac, the government. It's like I got a notification today that sometime today the government is going to buy $6.8 million worth of government-backed loans, and they do that every day of the week.
Okay. And the objective there is to maintain liquidity in the markets so that your company and others have the liquidity to continue to satisfy loan requests.
Right. We may have to sell a bunch of loans just to keep our cash available so we can continue to do business.
Mm-hmm.
Because there's brokers that are out there doing business, there's correspondent lenders, and then there's just the lenders themselves.
Sure. You mentioned a couple of times the credit history of the borrower. How do you measure that?
There are credit reporting companies.
Okay.
And we will reach out. Every lender has their favorite credit reporting company that they choose to use. We get the specific information, name, 2-year history of address, social security number, birth date, put that into their system, and then they'll go back in and they'll look at the credit report, and it comes back with who the debts are, how they've paid the debts, are they paying the debts on time, do they have too much debt, and then everybody gets a score.
Mm-hmm. And is that what we know as FICO score?
That's the credit scoring.
Do you know what that range is from worst to best?
0 to 850.
Okay.
And we go back to FHA first. If FHA you have a 640 credit score, you still can get the same kind of rate as if you have an 800 credit score.
Oh, really?
With conventional financing, it's tiered based on credit scoring from 620 to 680, 680 to 700, and so on up. And the better your credit score, most likely the more effect it will have on your interest rate availability.
So the better the score, the lower the rate, perhaps.
Perhaps.
And is there a minimum FICO score that if you see this number and it's below this minimum, you would just have to say, I'm sorry, I can't be of help?
At Axia, we have a minimum credit score of 640. I know that there are other companies out there that are at 580
Mm-hmm.
or something like 560. I don't know. I don't look into that market just because
Sure.
If they're in that low of a credit score range, they've got some issues with how they take care of their
Sure.
credit.
And that doesn't mean they can't get a mortgage loan. It just means that they may have to pay a higher interest rate and the fees may be higher.
Substantially.
Okay. Well, the real estate market is currently very strong.
Right.
Low interest rates, low inventory. It seems like we have a growing demand. How long can this last?
Well, we talk about it. I'm a member of the Salt Lake Home Builders Association,
Mm-hmm.
and in the board meetings that we have discussions about that. And right now, with the influx of people, the in-migration of people coming to Utah, leaving other states that don't have what we believe we have to offer as a state, as long as those people keep coming, the millennials, that millennial group is growing and they want to buy a house. We, in many aspects, are running out of ground. And so when the farmer owns 30 acres of property, he knows that that's going to be worth a lot of money.
Sure.
And
To a developer builder.
To a developer builder.
Yeah.
And so it's going to cost more because as great as the building community is, and real estate agents and everybody else in my industry, they're not going to just give it away because they're good guys.
Of course.
They're going to make money, and they have to pay for it to start with.
Sure.
So the availability of housing becomes the biggest of issues right now.
Dan, we have time for one more question. I want to put you on the spot.
Okay.
Can you tell us what interest rates are going to be next year in 2021 for residential home purchases?
Everything I read, if I was the smartest guy in the world, I'd be sitting on a yacht someplace. I'm not that smart guy, but for what I read, there's every possibility that we could see mid-twos.
Really?
Yeah.
So it could come back another 100 basis points.
Yes.
So is that going to stimulate more interest in buying?
Of course. Yeah, you can buy a lot more house at 2.5 than you can at 4.5.
Certainly.
But everything right now is going to be contingent on what the new administration does with the economy. What about Iran and China and on and on
Sure.
and on.
All the other variables.
All those variables that go into what potentially could happen to our market.
Indeed. That concludes this episode of Stringham Real Estate Edge. Today's program is brought to you by Stringham Schools, educating real estate professionals since 1989. Visit stringhamschools.com to learn more. We want to thank today's guest, Dan Densley, and don't forget to tell us what you think in the comments below. I'm Garry Barnes, and I'll see you on the next episode of Stringham Real Estate Edge.